Hi everyone, I'm Raymond, and I'm here to teach you about cap tables without using math and without using a spreadsheet. So I've been doing this a long time and teaching cap tables and workshops, and every time I try to teach using a spreadsheet, everyone falls asleep. So we're going to try to do it without anything except these wooden blocks here today. Your basic cap table looks like this. And one thing that I want to start off with is the word dilution. So everyone talks about dilution. It's actually kind of complicated to understand if you think about it in terms of percentages of what does 20% dilution mean? What does 30% dilution mean? Dilution means I'm going to add another co-founder. So now we're two. So this is 50% dilution. So previously you owned 100% of this company, and now notice that I've added 4 blocks. So that's a key thing about dilution. I mean, think about, imagine a cup of coffee. If you added twice as much water, you'd be diluting the coffee, and I would judge you for that. So now you own half of this great company. You've literally diluted 50% by adding twice as many blocks. So rule for this session is we're not going to do math. So those of you who love math can divide the blocks by the number of blocks, but let's not do that. Let's not get our calculators out in our spreadsheets. The whole point is not to do that. So if I added another co-founder, now each co-founder owns a third, right? You don't need to even do the math to visually figure that out. So I've gone from owning 100% to now owning a third, right? That's pretty fair. A third, a third, a third. So when you think about dilution, think about it as each one of these blocks is a share, which means that let's say you sold the company for, $12 million. Each one of these would be worth $1 million. So each share is like a claim on whatever pot of gold exists at the end of the rainbow. So adding more blocks, it's like inviting more people to your pizza party, right? It's great, but not so great if you don't have enough pizza. So that's how dilution works. So let's keep going with your 3 happy co-founders. So let's say that you built this company, and years down the road, let's say 10, you sell it for $12 million, then each of you gets $4 million, right? Each block was $1 million. Pretty happy. But what happens if halfway through, one of the co-founders left? So let's say green co-founder actually didn't stick around for the full 10 years. Then at the end of that selling for $12 million, again, everyone gets $4 million. The other 2 co-founders would feel a little bit hard done by because although the green co-founder, who shall remain nameless, did a great job for the first 2 years, that person didn't stick around. So that's why we have a concept called reverse vesting, which is something that I suggest all co-founders do when you set up a company. If you don't do it, often your investors will tell you to do that before they invest, and for good reason. So this is what reverse vesting looks like. It just simply means that imagine each one of these stacks is a year. Each year, you're actually getting the shares. So at the end, of those 4+ years and you sell the company, you get the same number of shares you would have had. So you're not losing anything. But it means that, let's say in our case, one of the co-founders left after 2 years. So year 1, these shares were issued through the vesting schedule. Year 2, these were issued via the vesting schedule. Now, the green co-founder decides to leave. In reverse vesting, that co-founder actually loses these shares. They don't lose the shares they've already earned, because I think that would be unfair, but they lose the shares they haven't earned, which I think is fair. So it means that after year 3 and year 4, fast forward to the exit, now the proportions are a little bit different. And remember what I said about dilution, the more blocks there are, the less piece of the pie you get. So I've removed 2 blocks, and that means the other 2 co-founders who did stick around for 10 years get slightly more. Reverse founder shares are actually a fundamentally fair way to split. And by the way, you don't need to split equally the way we've done it here. There could be one person who is contributing more, spending more time, has more industry experience. It's up to you. The beginning split doesn't need to be exactly equal, but obviously it can be. I'm going to put our poor co-founder back, pretending that they are going to stick around. Let's talk about safe notes and convertible notes, really. The most common way that seed funding is done, pre-Series A, is through convertible stuff. So convertible notes, maybe a bit less popular, and safe notes, super popular. So imagine that this is a seed funder who wants to put in a certain amount of money. So let's say it's $1 million, and let's say that this is a post-money safe for $4 million post-money. So I'm already throwing a bunch of terminology at you, but stick with me. So this safe is off to the side because even though it's a juicy $1 million, which is going into the company, these people are not shareholders yet, right? Because they are, the way a safe and a convertible note works is they convert into equity later. So this is your equity stack. But at the beginning, they just hold a contract that says at some point in the future, there'll be a trigger and I'm gonna get equity. That's what I want. But remember how I said that they're investing $1 million, and as a post-money safe, they've said, we're gonna cap the valuation at $4 million. So imagine now, if you fast forward to that event, which is gonna be triggered when another investor says, I want to invest, like let's say the Series A. So when these safe note holders convert, this is what it looks like. So they've gone from being off to the side to converting into shares. And because they said it was a $4 million cap and I invested $1 million, that means they get 25% of the company. That's exactly how it works. So in other words, 1/4 of the stack of these wooden blocks. So when you think about safe conversion, a lot of people don't understand that the conversion happens like a millisecond before the next investor. So a lot of people think, safes and convertible notes, they convert along with and at the same time as other investors. That's actually not true. So they convert just before the next investor. And why that's important is, imagine now that I'm going to add the next investor. This is the seed funder, let's say. So it means that, notice that just before they owned 25% of this stack, so one row of the stack. But as soon as I added the next investment, so the yellow safes converted and the pink seed funders now have joined, now my safe note holders don't own 25%. They own 20%, right? Because I've diluted them by adding more wooden blocks. So that's one thing that I think a lot of founders don't really fully understand is that, and hopefully the investors understand this, is that the safes convert before the next investors, so they're diluted by the new investors. Okay. Now in this case, let's say that the new investors, the pink seed funders, let's say that they said, I'm going to invest $2 million, and I now value the company post money at 10. So the reason that the safe holders don't mind being diluted is because right here they own 25% of a company worth $4 million, and now 1 second later, thanks to the new investors, that company not only has more money, but it's worth $10 million. So they've got a bump, and that's how the cap works. That's kind of like, think of it like that's their incentive for investing early when the company was more risky. But hold on, there's one thing that happens usually at the seed round or at very latest the Series A, and often even before both. It's the employee stock option plan. So basically a pool of options and equity reserved for employees. Many of you already have this. So what happens is, let's say that I'm targeting, I want to have a certain amount. Again, we're not doing math. If you did and you divided 3 by, let's see, 1, 2, 3, 4, 5 by 23, you would actually get exactly 13%, which is exactly the median early stage size of the ESOP. But again, we're not doing math, so forget I just said that. So these blocks are the employee stock option pool. And that means that this makes sense, right? So I've got my options now, my investors, my safes converted, and my common shares. But this is actually not right, because when the investors invest, they say, we want you to have a stock option pool, but we want that pool to be created before we invest. Meaning when we invest, it's going to add more dilution, but the stock option pool doesn't dilute us, it's only going to dilute you. So it's not great for the founders and the safe holders, but that's a convention. You can have that conversation with your VC. But what it means, the difference I want to point out is, this is actually what happens. So after the safe converts, I add more blocks for my stock option pool. Then the new investors come in, but there's one thing missing, because remember, these new investors, the Pink Fund LLC, has come in and said, I want exactly 20%. But if you actually took these 4 blocks and you divided by, now there's 23 blocks, it doesn't actually work out to 20%. You have to add another block, okay? Still not exact, but again, we're rounding up and down. So now, as a result of doing this in a different order, meaning the stock option here, these folks here, by adding them before the investors come in, we actually had to give the investors more shares to maintain their 20%. Okay, so there's nothing wrong with that. This is actually a convention. You can try to negotiate that. You probably won't succeed. But the important thing is that by doing things in a different order, founders need to be aware that even though you think you're negotiating a $2 million raise at a $10 million post, what you're really doing first is converting the safes, then adding the ESOP, then adding these shares. So your total dilution, you can just see, your total dilution is this. Okay? So in this case, it's 50%. Okay? Again, no value judgment. Is that too much? Is that too little? That's not the issue here. It's for the co-founders to understand, in this case, from where we are right now, we have diluted 50%. So the difference, you could say, between creating the employee stock option pool before and after the new investors is the difference between having 50% or slightly more than 50% of the cap table, otherwise having control. Okay, so here is our nice cap table. Now let's talk about what happens at the end of the company. Hopefully it's a positive exit. So if somebody came to me and said, I want to buy this company, 1, 2, 3, 4, 5, 6 times 4 is 24. Let's say for $24 million, then obviously every person here gets $1 million, or every block is converted into $1 million. So it means that half goes to the investors and the employee stock option pool, half goes to the co-founders, and everyone's happy. That's a very simple waterfall. But let's talk about situations where it's not so simple. So imagine that it wasn't $24 million. Imagine that somebody offered to give me, let's say, $3 million. It's not great, but we tried hard and we found somebody to buy some of the assets. In the case of a $3 million acquisition, that money is not divided equally. And the reason for that is, if I separate the stack now, there's actually 2 stacks. One is a stack of people who owned preferred shares, and one is a stack of people who held common shares. So as the name suggests, you'd always want to be preferred than common. So usually with preferred shares, there's a special rights. It could be board seat, could be different control provisions, and especially now, definitely a liquidation preference. So as the name suggests, liquidation preference means in a liquidation, we get more stuff. And more importantly, we get that stuff sooner. So let's say somebody offered $3 million for the company. The people with the liquidation preference, let's say it's a 1x liquidation preference, it means that these preferred stack get the first $3 million, right? Because in total, the safes invested 1, the seed investors invested 2, that's 3 total. So unfortunately for the common shareholders, including the employees, they get nothing. And the preferred stack gets all $3 million. In the case of I talked about liquidation preferences, but there's another case, which is, let's kind of rebuild this stack. Another case is, let's say it's more than a $3 million exit. Let's go back to that $24 million exit, which everyone, well, I liked it because it was just simple. Everyone got $1 million who had 1 block, but it seems like a reasonable exit. But in many cases, the people who own the preferred stack here might say, you know what, we're going to veto this exit. That's one of our rights. We're going to say, no, you can't sell for $24 million. And founders might think that's terribly unfair. How come? And the reason is because the people over here are professional investors, right? Especially if you run a fund. And the way the fund works is they need winners. So we're not going to go into fund math, but the way funds are structured is they're obviously is risky investing in startups, so they need big winners. And even though $24 million might seem like a lot of money, it is a lot of money. It's exactly $4 million for every co-founder here. But for the people who are running a fund who only get a percentage of the profit if the fund really goes big, they need this to be a $100 million exit, a $1 billion exit, an IPO. And if there's even a small chance of that happening, they would rather go for it and go all in, if this were poker, than just get 1, 2, 3 times back their money. So that's really important for founders to understand the difference between the motivations of people on the preferred share stack and the motivations of the people on the common share stack. Often they are aligned, by the way. I'm not saying that founders don't want big exits, but I'm pointing out that once you add outside investors, your interests may diverge. Maybe you've been working at the company for 10 years and you want to sell. Maybe the investors don't want you to sell because they want you to go another 10 years if there's a chance for an IPO. It's important to understand that those motivations can diverge. If you're not sure, number one, understand how the cap table works. Talk to your investors, make sure you're aligned on the exits. When you're constructing a cap table, and we talked about dilution and, liquidation preferences and vetoes, remember that the reason you do that is it is a trade-off, but it's one that hopefully you're making consciously. I want more resources. I want more people. I want a strong board and advisors. I'm going to give them something, and these wooden blocks, but hopefully I'll get something in return.